much, ladies and gentlemen. We are going to start today's Biz Talk. Can everybody make sure they have pen and paper in hand? Today's topic is talking about financial computation and the different formulas we use to analyze a business's financial capability. Whether we have a business going and you want to know its true financial state, or whether you're planning to open a new business. So I want you to listen carefully, write things down, and don't worry about it. I'll give you the PowerPoint at the end of the session. Okay? If you are at work and you have sent me a message, you can switch off your camera on the understanding that should I call you at any time, you need to show me that you're at work. Thank you. All right. So today we're going to look at what elements or what measurements do we need to understand when we consider whether a business is financially viable, whether expenses outweigh estimated revenue, or whether you can make a profit. So what I'd like to do now is I'm going to share my lesson material, and we are going to start today's lesson. So could everybody please make sure that you actually listen to what I say, and we'll go from there. One moment, please. Just hold on. Okay, guys, I'm sharing my screen to both systems. Just give me a moment, would you? Okay, here we go. Okay, so today, ladies and gentlemen, we're talking about financial know-how. Can everybody see my screen? Could you put your hands up if you can see my screen? Elsie, can you see my screen, Elsie? Thank you very much. Good, excellent. Okay, let's look at the other screen and let's make sure they can see me. All right, Maria, can you see my screen? Maria Cecilia? Thank you very much. So today's, ladies and gentlemen, as I said, we're talking about financial model and know-how. What does that mean? Before you open a business, you don't only want to think of what sort of business you're going to open. You want to think of this business model so far as numbers. A lot of you work overseas, you save up your money, you save up your fortune, you go back to your own country, you try to open a business, and after 2 years, you lose all your money and you have to go back and work again. That's because you don't actually go through financial calculations and analyze whether the business can survive financially before you even go down the line of investing your money. And this is a sad point because a lot of people make this mistake and lose their money. So today, I want you to understand what the definition is of financial know-how. Financial know-how is planning, raising, managing, and analyzing money to run and grow your business efficiently. Now, if you're investing your own money, it's fine. But before you invest your own money, you need to understand whether you do have enough money and how long will you be able to sustain the business should you not be able to generate enough revenue. I will show you the core scope. What are the critical decision-making decisions so far as you investing in assets? How much financial capital do you have to have in order to be able to pay the bills in the first 12 months? We will look at the objectives on how to maximize your profit and maintain liquidity or solvency. What do we mean by solvency or liquidity? If a cash is solvent, if you are cash solvent, it means that you have cash in the bank. If you have financial liquidity, it means you have cash in the bank. Some people say that you're financially solvent, you have money. If you're financially insolvent, it means you're broke, you go bankrupt. But if you're financially solvent, it means you have a bank balance to run your business. Stakeholders, who will own the business? Are you going to be the sole owner and you're going to use your own money, Or are you going to bring in a partner or an investor who will co-own the company with you? And last but not least, ladies and gentlemen, we're going to define what outputs you should expect, what key performance indicators you should set for the business should you think or should you be able to calculate that it will be financially viable. Let me give you a hypothetical example or a scenario. Elsie, if you start a business and your rent is $200 a week or $200 a month, and you're selling fried rice, and each portion of fried rice you sell for the equivalent of 20 peso. 20 peso, you would have to sell enough fried rice to pay your rent, to pay for all the raw material, the gas, the air conditioning, the plates, the dishwashing water, the dishwashing soap, and pay yourself a salary. So how do you know whether it would be viable for you to run a fried rice business, and how would you know what is the right price to sell it at in order to meet your expenses? How do you understand what your total expenses are? This is what we will learn today. All right, so first one, why financial knowledge matters. Why do you need to have financial knowledge?
In this device, we need to change the slide.
I can't hear you, Medina.
Slide not changing, Wally.
Just one moment. They're changing from my end. Okay, let me try again here, please. Just one moment, please, guys. Hold on, guys. I'm not sure why this happens, this Zoom 10 every week. Just bear with me for a moment, please. Can everybody see my slide now? Yes or no? Can you see it now? Okay, guys, please, if it happens again, somebody say something. Thank you, Medina. All right, guys, so let me just test this. Okay, is it changing now? Okay. All right, so, sorry, I have to go back to where I was. Okay, so now we're looking at why financial knowledge matters. Financial knowledge matters because you need to understand certain financial numbers in order to know whether you will have enough money to run the business. So the first reason why you need to understand financial numbers is so you can make informed decision. You can decide whether you want to take the risk with your savings or you have enough money to set up the business and run it for 6 or 12 months. Because a business should be a 12-month plan or a minimum 6-month plan. If you don't have money to support the business for 6 months, you need not to bother going into business. So informed decision-making means being able to assess whether the product you have or the service you have, you will be able to sell at a price that people can afford and be able to generate enough income to cover your expenses. The second part of information that you'll receive, ladies and gentlemen, is risk mitigation. You'll be able to tell early whether you're going to have a problem and go broke, whether the prices you're selling at are too low, or whether you need to adjust them, or what you need to do to lower your cost. You need to understand what is needed so far as access to capital. You need to be confident that you have enough capital in order to run the business. And you will also know by this financial analysis or estimate at the beginning, before you start the business, whether you need to bring in an outside investor because you need capital to buy equipment in order to start the business. Because if you spend all your money on capital, how are you going to pay daily operation expenses? And the last one down there is not difficult. I know some of you are looking at me and saying, oh, what is this? Valuation uplift is what you need to drive sustainable growth. Okay, what do you need? How much money do you need to invest or keep pumping into the business to make sure the business and the revenue keeps growing? So if we look at the other side of this PowerPoint, ladies and gentlemen, if you look at the, just bear with me, would you, for a moment? Okay, if you all look at the other side of the PowerPoint, performance benchmarking is you having a benchmark, you knowing what your minimum selling price is and how much of that selling price is profit. You need to have a minimum profit benchmark. For example, you're producing fried rice and you're selling the fried rice for 50 peso per packet. After you've paid all your expenses, including rent, electricity, and labor, you should actually have a minimum profit margin. It could be 40%, 50%, or 30%. Actual fact, it should be more. If you're selling fried rice from a street stall or just a local small restaurant at the front of your house or a little cafe, you should be able to have at least 70% markup on your fried rice, because the fried rice, the cost of the food, the raw material, should not exceed 30%. These are all elements that you need to have sorted out and have performance benchmarks for. The next one is alignment, strategic alignment. By you having benchmarks and by you having financial estimates and by you being able to keep accurate record of your finances from day one, you can automatically decide how much cash you need in the bank, how much you need to actually stash away every month before you start expanding in order to keep the business open so you can expand it. So strategic alignment means being able to make sure you have enough hard cash in the bank to pay salaries and to pay your suppliers so you don't go into insolvency or bankruptcy. Yes, I'm being serious about this, Nanda. Business is all about money, Nanda. Do you understand what I'm saying, Nanda? Wave your hand to me, Nanda. Nanda, Twee, do you understand what I'm saying, young lady? Yes or no? Good on you, Nanda. Okay, all right, good. Sorry, I love that smile. Smile at me when I talk to you, young lady. Okay, good. Arsalan, do you understand what I'm saying, Arsalan? Do you understand how important financial planning is? Very good. Okay, good. What about you, Nan? Do you understand how important financial planning is so far? Nan? Wave to me, Nan. Don't just give me a smile. Nan, Tan, Lu, wave to me. Good girl. Excellent. All right. So last one is operational execution. Now, a lot of people go into business and after 1 week, they see the money coming into the cash register and somebody like Jackie will think she's rich. So she'll go out and buy herself a Louis Vuitton bag from the sales she made yesterday, forgetting that those sales should go into the business bank account to pay expenses. Just because you run a business doesn't mean you spend what comes in. The money belongs to the business. You can only deduct the salary. So based on the salary you've estimated before you open the business, you must follow your operational execution plan. You must make sure you meet the targets. You must make sure you maintain the expenses based on your budget. And you must make sure you only take the salary you planned or budgeted for. That is part of operational execution. All right, so let's go on, ladies and gentlemen. Okay, so can you please confirm the slides have changed? Okay, good. So let's look at one tool that we use. The first tool we use, ladies and gentlemen, is a balance sheet. I repeat, assets have to be in proportion to liabilities plus equity. So let's talk about assets. Assets equal liability plus equity. Current assets, these are ones that you have now. They are cash and equivalent, account receivables, and inventory stock. Non-current assets are property, plant, equipment, intangible assets, patents, goodwill, or long-term investments? Let's look at the liabilities that a business must have. What are the liabilities that a business could have, not must have? Claims by outsiders, debts or obligations. Current are accounts payable immediately, and accrued are accrued expenses. Okay, long-term liabilities are long-term bank loans, bonds that you have outstanding. And the equity, on the other hand, guys, is claims by owners on paid-in capital. What does this mean? That you invested $20,000 capital, and that is your equity in the business. Does everybody understand this? Yes or no? Okay? All right. So remember, assets equals liability plus equity. So your assets are what you own plus the liabilities owed to the business and the equity in the business. Do you understand that, guys? Yes or no? Okay. All right, so let's go to the next part. Let's look at this example, all right? Everybody see my slide? Okay, here we have an income statement flow, understanding how the top line works. All right, so when we say understanding the top line, ladies and gentlemen, just hold on for a minute. Guys, let me just get rid of this. When we say understanding the top line, let's look at the profit and loss for Waterfall. This is a company, okay? Let's look at their income. Let's look at their cost of goods sold. Let's look at the gross profit, operating expenses, operating income, and tax and interest on loans. So revenue is calculated as total sales generated from goods or services before any expenses, also known as turnover and sales. Please understand and learn this, all right? Revenue, cost of goods sold, gross profit. What's left after paying the direct costs, material, raw material, labor, indicates core production efficiency. So your cost of goods sold should be less than the revenue you receive. Gross profit minus operating expenses. So remember, gross profit is revenue minus cost of goods sold. Gross profit is minus operating expenses. So operating income is profit from the core business operations after you deduct research and development, depreciation, and sales, cost of goods, okay? So right here, you need to understand what your estimated gross profit is. And we'll look at that, and you'll see that when you use the Excel sheet, because I know some of you are not mathematicians. So the Excel sheet I've given you will calculate that for you automatically. Does everybody understand this? Yes or no? Okay, good. Now, let's go down to the last part here. Net income is the bottom line. Okay, so the bottom line is your net income. The top line is what you need, what is coming in, but the bottom line is your net income. The bottom line is the actual profit available to you, the owner or shareholder, for you to use or to reinvest in the business. So you should always look at your net income, your bottom line, before you make any plans to expand or spend the money. Does everybody understand that? Yes or no? Okay, let me give you a quick hypothetical example. I want you to listen to this strategically because you guys need to understand it in simple terms. None of you are accountants, okay? Listen carefully. I open a restaurant. In my restaurant, I sell fried noodles and fried rice. Okay? Listen carefully. My rent every month is $100 US. So therefore, I need $1,200 a year in rent. My electricity bill every month is $50. Over 12 months, I need $600. So right now, we got 1,200 plus 600 is 1,800. You also do the cooking and selling by yourself, and you pay yourself a wage of $200 a month times 12 months is 2,400 plus the 1,800 you already planned, right? So if we add up 2,400 plus the 1,800, you have now 4,200 in expenses every year. Everybody understand that? These are just basic expenses. We haven't even counted the cost of buying furniture, setting up your kitchen, or raw materials, okay? Listen carefully. $4,200. Now, we understand that the cost of preparing my fried noodles or fried rice per portion is 75 cents per portion. I sell that fried rice for $1.50. So I'm making 100%. 75% cost, 75 cent cost. I'm selling it for $1.50, right? So I'm making more than 100% profit, right? Yes or no? Yes or no? 50 plus 50 is 100. 75 plus 75 means what? 150, right? Yes or no? Okay, so out of that $1.50 that comes into the business, my profit is only 75 cents. 75 cents, right? So how many portions do I have to sell a year in order to generate $4,200? So 0.75, just give me a minute, please. 2,400. So you need to sell more than 3,200 packets of fried rice or noodles per year just to raise your basic expense. Do you understand that? These are the basic costs of $4,200. You need to sell 3,200 packets a year. Now, you need to understand, if I'm going to get that just to pay my expenses, no profit. Out of that, all I'm paying is my expenses. As I said, rent, cost of raw material, electricity, and salary. No profit in the bank, right? So if 3,200 only gives me my basic income, then in order to make a profit, I need to sell 6,400 packets. You need to take out 6,400 packets divided by 52 weeks in the year. Every week, you need to sell a minimum of 135 plates of fried rice or noodles. If you only sell 20 a day, you're already losing money. Does everybody understand this? Yes or no? You understand the hypothetical example? I'm trying to make it simple for you guys, okay? Very simple, because I want you to understand it from a simple person's point of view. And if you can't do these basic calculations before you start, you're going to burn your money. You follow? Okay, let's go on. So let's go on. Let's talk about operating core business, investing growth and assets, financing your capital structure. Okay, so let's talk about this in simple terms. Okay, operating your core business, cash generated from or used day-to-day operations. And that includes net income adjustments after depreciation and amortization of your equipment, and changes in working capital, which is accounts receivable, inventory, and accounts payable. Positive cash flows here indicates a healthy core business. Let's look at investing. Cash used for buying or selling long-term assets, capital expenditures, CapEx minus buying of core equipment at the beginning, okay, and acquisition or selling investments. The key insight here is usually negative for growing companies investing in the future, because here what you're doing is you're not keeping any cash. You're putting all your money into investing into the future and expanding your business. Let's go to financing, capital structure. Cash flow between the company and its owners or creditors. Issuing or repaying debt, loans or bonds, equity issuance or dividends paid. This shows how the company funds its growth. The equation here, ladies and gentlemen, is net change in cash equals operating plus investing plus financing. And this means cash flow is not the same as profit, net income. A profitable company can still go bankrupt if it runs out of cash liquidity. Do you understand that, guys? You can be making a profit, but every time you make a profit, you spend it and you have no liquidity in the bank to pay your monthly expenses. You can still go into negative numbers. And if you have no money to pay your rent and electricity, you have to close shop. Does everybody understand this? Yes or no? You only need to understand these as basic principles because the Excel sheet I've given you will calculate this for you. Do you understand that? Yes or no? Okay, good. All right. So let's look at the definitions now. Definition, the formula, gross profit equals revenue minus cost of goods sold. Everybody, repeat after me. Gross profit equals revenue minus cost of goods sold. For example, the direct cost attributed to the production of goods sold or services delivery by a company represents the cost of creating the product itself. So let me ask you, if you sell lamb chop in your food place and the lamb chop costs you delivered by the butcher to your restaurant $2 per chop, then you have to cook it. You need butter. You need to baste it with butter. You need to use the gas. You need to actually put salt and pepper. You're going to cover it with a black pepper sauce. You need to actually add up how much it costs you in butter, how much butter you waste, how much pepper you put in, how much does a pepper cost, how much salt do you put in, how much does the salt cost. When you put it on the plate, are you going to serve it with French fries? How much does a portion of French fries cost? You need to measure all this and weigh it out so you know what the cost of that lamb chop is when you sell it. If you don't know that, then you'll never make a profit. Do you all understand what I mean by cost of goods sold? Yes or no? Okay, so let's look at this. Includes direct costs, raw materials, direct labor, wages of production or the cook in the kitchen, factory or kitchen rent and utilities, electricity and gas, hot water. And if you need to bring goods in from overseas, like you're importing fresh lamb from New Zealand that's chilled or frozen, that's also a cost. It excludes your operating expenses. It excludes sales and marketing expenses. It excludes research and development, and it excludes your administrative costs. For example, your financing costs, your accounting costs, your interest, your taxes. Does everybody understand that? Yes or no? All right. So if we look at the example given here, total revenue was $1,000. The cost of the goods we sold was $600. The gross profit earned was $400. So our gross margin is 40%. Is that high enough? No. In today's business, if you're running a food business and you're running just a normal local food shop, your gross margin should be at least 49 to 51%. Otherwise, you will die. Okay? Now, if you're running a bistro or table service where you employ waiters or waitresses, then your gross profit should be at least 35 to 40%. But if you're running a two-man or one-man operation from your house or from a local, from a little space at the front of your house or outside your house or at a market, you should be looking at least 60% gross profit. Does everybody understand that gross margin? Yes or no? Okay. So let's go on. What are operating expenses? What are they? Definition: indirect costs incurred to run the daily operations of the business, distinct from direct costs of production, which are the costs associated with making the goods, cost of goods sold. Components include selling, general and administrative expenses, SG&A, which means marketing, research and development, rent, utilities, and non-production payroll. Remember, when you calculate the cost of goods sold for making fried rice, that's only what you spend to make the fried rice. But you've still got electricity bill for the whole restaurant, for the dining room, the air conditioning, and everything else. Also, your payroll involved with your service staff. The payroll for the cook in the kitchen comes under cost of goods sold. The payroll for the people in the factory who produce your goods comes under cost of goods sold. But the payroll for the people who sell it or the people in the office come under SG&A. All right, let's talk about other characteristics. Operating expenditure, ladies and gentlemen, is typically treated as a period expense. They are fully deducted in the accounting period they are incurred, unlike capitalized assets. Because when you buy assets or equipment, you capitalize them. They become an asset. You've invested in them. But operating expenses can never be capitalized as assets. Efficiency focus. Remember, operating expenses can be reduced providing you're able to actually maintain efficiency, bring automation, and make sure you have zero budgeting to improve margins. What does zero budgeting mean? As follows: that if you budget $1,000 to renovate your restaurant every year and you don't spend it by the end of the financial period, that $1,000 goes back to the business. You cannot carry it forward into the next year. All right? Because $1,000 you didn't spend goes back. Next year, you get another 1,000. You can't say, I keep that 1,000, I build it up to 2,000. If you're starting a new business, you're better off to resolve on zero budgeting, okay? Because if you don't do that, you'll get into trouble because you won't know how to manage your capital expenditure or your operating expenditure, okay? Does everybody understand that? Yes or no? Okay, you need to be focused on efficiency, as I said, and practice zero-based budgeting and financial impact. You need to understand that your operating expenses will reduce your operating margin, okay? You need to reduce your operating margin by reducing your operating expenses. But if you reduce your operating margin by reducing your operating expenses, okay, does not affect your gross margin, because lower APEX leads to higher operational efficiency. And if you lower your OPEX, your operating expenses, you will have more operational efficiency, and therefore you will have higher gross profits or gross margin. Does everybody understand that? Yes or no? Okay. All right, let's go into the next one. We're talking about capital expenditure. Capital expenditure. Remember, OPEX is operating expenditure and capital expenditure is different. Okay, they're two different things, Nanda. Okay, what is the difference, ladies and gentlemen? What is the difference? Definitions: fund used by company to acquire, upgrade, and maintain physical assets, such as the building, the plants, the equipment, the technology, the machines, are CAPEX. CAPEX. These are money you spend to invest in equipment. They're different to OPEX. OPEX are operating expenditures. CapEx is investing in assets. All right. Capitalization approach. Costs are not fully expended in the year. They are incurred. Instead, they are capitalized on the balance sheet and expensed over the time via depreciation and amortization. Now, again, if you buy a machine worth $25,000, okay, it doesn't become an expense in the first year. You can actually depreciate that and amortize the expense over 5 years or 10 years in your balance sheet. Okay. Now, remember, when you start a small business for the first time, you won't want to worry about this because you need to invest in a business where your capital expenditure is at a minimal. Okay. Don't try to go and spend $45,000 on a kitchen or kitchen equipment when you're not sure you're even good at running the business. Start smaller first, maybe rent a restaurant or a shop that already has equipment, or buy basic second-hand equipment and maintain low capital expenditure to start with. All right. One good thing you have to remember here, projects are typically assessed for financial models using net present value and internal rate of return or payback period. I don't want you to worry about that because NPV and IRR are way beyond a new business. These are two measurements you will only look at after your second year or third year of business, because in your first year of business, your main focus will to be able to generate revenue, make a profit so you can expand your business. What is the impact on cash flow? What is the impact on cash flow? Results in an immediate significant cash flow, okay? Cash outflow. So by you investing in assets and machinery, you'll be spending cash that you're holding in the bank. While the profit and loss impact is smooth over the asset's usual life. So when you actually pay it out of cash, you put it in your balance sheet over a number of years. But what you're doing is you're reducing the amount of cash in the bank. So you have to make sure that before you go on a CapEx expenditure, you have enough money to maintain your operating expenditure. Do you understand that, ladies and gentlemen? Yes or no? A company can be profitable. You can be making money. But if you spend all that money and don't have money to pay your ongoing expenses, you'll go bankrupt. Does everybody understand this? Yes or no? Yes or no? Yes? What do you mean, Arcelin? I don't understand. Do you understand or not? Yes. Okay. Okay, good. All right. So remember, cash outflow, immediate cash spent, recorded in the cash flow statement. You record it as money you're investing, so it comes out of your bank account. Asset recognition. Once you spend the money on assets, those assets become an asset to the company. But the fact is you don't have money in the bank. So how can you pay your salaries if you put it all into machinery and don't keep enough money to pay your rent, buy raw materials, and pay salaries? And depreciation, that is the cost you've allocated over the life of the machine. So if you expect that machine to work for 5 years, you would depreciate the money you spent over 5 years. And you'll learn about financial depreciation of machinery in another lesson, because we're getting into very high level financial management analysis. But in your balance sheet that I've given you, in the software I've given you, it actually calculates depreciation for you automatically. Do you understand that, everyone? Yes or no? Okay. All right, guys. So now let's look at the key terms of accounts payable versus accounts receivable. All right. Accounts payable is what you have to pay. Accounts receivable are money that is owed to you by your customers. Does everybody understand this? Yes or no? Again, payable is what you have to pay out. Receivable is what the customers pay you. Payable is out, receivable is in. Do you understand that, Maribel? Maribel Rosario, thank you. All right, so accounts payable is money owed to suppliers, money owed to the people that you have to pay every month. Short-term debt obligation to pay vendors for goods or services received but not yet paid for. Extending payment terms, example, 60 days keeps cash in the business longer, acting as interest-free financing. Now, if your supplier will give you 30 or 60 days credit, that's good. But a lot of suppliers will not give you credit if you're a new business. Because remember, when you put the money in the bank, you're earning interest on that money. So if you can hold that money for 60 days, then pay your bill, at least it shows the bank that you have a minimum balance in your account. And that will make it easier for you when you go to borrow money for your business after the first 12 months or 24 months, if you do not borrow at the outstart. And some of you will not be able to borrow at the outstart because you've got no business track record. Next one, risk. Delayed payments can damage supplier relationships, incur late fees, or result in credit holds. So remember, if you get credit from your supplier for 30 days, you must pay them on time. Because if you don't, some of them will charge you interest or even refuse you credit in future and tell other suppliers not to give you credit. All right, let's talk about accounts receivable. Accounts receivable is money owed to you by your customers. But for most of you, you're going to be running cash businesses where you sell fresh food or restaurants or sell goods online where you receive your payment in advance. Funds legally owed to the business by customers for goods or services delivered but not yet paid for. So for you, most of you will run cash businesses where you sell online and get paid first, unless you're selling from business to business where the customer asks you to send them an invoice and pay you 30 days. But if you're doing business with consumers out in the open market, it should be cash upfront or payment upfront before delivery, or if you're selling food, payment on the spot once they've eaten the food. Accelerating collection, reducing the debts outstanding or debtors list, reducing the number of people you give credit to improves your cash flow and your liquidity is constant. Management tools, you need to have very strict credit terms, early payment discounts if you give credit. But as I said, as a new business, I do not encourage you to give anybody credit. Does everybody understand that? Yes or no? Because if you give your customer 30 days credit, you have to have enough money in the bank to buy more raw material for those next 30 days and pay your salaries for the next 30 days. Otherwise, you go bankrupt before the customer pays you. So in order to give credit, you must have cash liquidity to carry you until the customer pays you. Does everybody understand that? Yes or no? Okay. All right. So we're going to look at the calculation for gross margin. Okay, so remember, the interpretation for gross margin is revenue minus cost of goods sold divided by revenue, okay? All right, so if we take revenue at 200,000 minus cost of goods sold of $1,200, your gross profit is 800. As a percentage, it would be 40% of the revenue you earn, 40% of $2,000. Does everybody understand how we calculate gross margin? You just have to remember these because the Excel sheet that I've given you will calculate them for you. You just have to understand how the actual figure is derived. Do you all follow this? Yes or no? Maribel? Maribel? Okay. Do you understand, Maribel? Okay, good. Well, it doesn't mean anything, Maribel. You have to focus. And Maribel, you don't have to know the formulas. You just have to understand what gross margin means. The Excel sheet that I gave you will help you calculate it. All right, Maribel? Okay. Do you follow what I'm saying, Eugenia? Very good. All right, guys, let's look at the next formula. The next formula is operating margin, which is operating margin equals operating income. Okay, so let's work out how that works. Okay, gross profit was $800. Your operating expenses were $500. Therefore, all you've got left in the bank is $300,000 because you had a gross profit of 800,000, but you had operating expenses of 500,000. So your operating income in the bank should be 300,000. So it's gross profit minus operating expenses, which gives you operating income. All right, let's look at net profit margins. Net profit margins. Your net profit margin is your net income divided by revenue. So remember, your total revenue was $200,000. Your net income was $180,000. So if we look at that, we go 200,000 minus 200,000 minus, not minus, actually divided by 180,000. Okay, so you divide the smaller into the larger. 180,000 divided by 200,000 times 100 over 1, it means your net profit margin was 9%. Is 9% acceptable? No. You should be looking for at least 10 to 15% net profit margin. Does everybody understand that? Yes or no? Yes or no? Okay. So what you're saying here is net profit margin is basically your bottom line. Unlike gross or operating profit margin, net profit margin accounts for all expenses, including interest on debt, income taxes. It shows the percentage of revenue that actually remains as pure profit for you, the owner and shareholders. So if you as owners are not getting at least 12 to 15% profit, you shouldn't be running the business. Okay. In fact, if you're running your own online store or you're running a digital business, your NPM should be at least 30 to 40%. If you're running a food business, retail, okay, or you're running a service business where you have rental on a shop front, again, it could be up to 15, 20% in your first year. But if you're running an online business, you should definitely be looking at 30 to 40% minimum NPM. Does everybody understand this? Yes or no? Okay. All right. So let's look at return on your investment. What do I mean by return on your investment? So let's assume that Maribel worked overseas for 10 years. She came back to her country with $500,000. She decided to open her business and invested the whole $500,000 into her business, right? Now, how does she calculate a return on her investment? A return on investment is net return minus cost divided by the total cost. So let's look at this. You invested $200,000 in a new production line. After 1 year, the total value generated a net return of $260,000. So investment cost was $200,000. Total return was $260,000. The net profit was $60,000. So $60,000 divided by the $200,000 would give you a net return on investment of 30%. That is a good return if you're going into a new business. That is a very good return. Does everybody understand that? Yes or no? Okay. Let's look at revenue streams. Okay, we have revenue from product sales. Okay, we have revenue from product sales. Okay, and then we have what is known as service revenue. Just bear with me for a moment, please. Let me share my screen again. Okay, so we have two. We have sales and service. Just bear with me. Why is this happening to me today? Just one moment, please. Okay, we have product sales and revenue from other professional services. All right, so let's go through this and let me explain them in very basic terms. All right, here we go. Just give me a minute. Let me get this out of the side. Okay, just give me a minute, guys. Here we go. So let's talk about this. Product sales, transactional revenue. Okay, revenue stream number one. Okay. Asset sale, traditional transfer of ownership or rights for a physical product typically generates one-time revenue. So you're selling goods, okay? Whether it's food, furniture, or assets, you're selling goods, one-time revenue. Characteristics, requires inventory. You have to have stock to be able to sell it to generate revenue. Professional services, okay? So professional services are different to actual product sales. Product sales is when you sell fried rice, noodles, toys, t-shirts, etc. Revenue on services is when you actually do cleaning services, gardening services, laundry services. Does everybody understand that? Yes or no? Okay. Or you could be selling transactional services, based revenue generation. So you could be selling cloud-based storage, okay? And you could earn money from the amount of data people store in cloud storage. Or transactional fees, revenue generated for successful transactions facilitated in a common marketplace. So you have a website and you could actually provide a link between yourself and between the buyer and the seller. For example, there's many of these out there. I have a website and I allow people to advertise their secondhand clothes. Now, people go to my website, they advertise their secondhand clothes and sell them. But once they sell them, I get a commission out of the money that they earn because they use my website. I get a transaction fee. Does everybody understand what I mean by that, Marvin? Now, if we talk about Airbnb, Marvin, Airbnb, ladies and gentlemen, does everybody know what Airbnb is? Airbnb, bed and breakfast. You can book to rent somebody's house. If Marvin is going to the US, New York, and he wants to stay in a $500,000 apartment in New York, he can rent that apartment for one day through an Airbnb website, right? So he goes, he searches for the apartment. He actually communicates with the owner through the Airbnb website, and the owner wants $600 a night rent. So Marvin pays $600 by his credit card to the owner. But does the owner get the full $600? No, because the Airbnb website charges the landlord 30%. So $600 times 30%. So Airbnb, the platform, will get $180 and the landlord will only get $420 out of the $600 that Marvin paid. Do you understand that example, everyone? Yes or no? Do you understand that, Eugenia? Yes? Okay, good. All right, so let's go through more of this, and then I'll answer any questions for you. Okay, I promise I'll answer all your questions. All right, let's talk to Cecilia. Cecilia, do you understand what I'm saying? What about you, Jane Valdez? Do you understand what I'm saying, Jane? Very good. Do you understand what I've said, Joshua, about Airbnb? Let me give you another example. If you go to a pub, does anybody go to a pub to drink beer? Who goes to a pub? All right. Now, if the pub is owned by the brewery, say in Australia, if you own a pub, the pub is not yours. The pub building is owned by the brewer of the beer. Okay? You rent the pub off him. So when you pay him rent, every glass of beer you sell in his property, he gets a percentage of as royalty. And you pay him for the raw material. So when you buy beer off him, you buy $15,000 worth of beer, but you sell $45,000 worth of beer. He will also get 2% of the 45,000 on top of what you pay him for the beer originally, because you're using his property. Do you understand that, everyone? Let me give you another example. Does everybody know Coca-Cola? Who knows Coca-Cola? Put your hands up. Who knows Coca-Cola? Does anybody know how Coca-Cola makes money? Coca-Cola makes money from actually having the bottlers buy its syrup. So in China, Coca-Cola has a bottling facility, which is run by a third-party company. So when these people come to Coca-Cola and say, I want to bottle and distribute your product in China, Coca-Cola will give them guidelines to set up a factory. Coca-Cola will show them the factory and the equipment. And then Coca-Cola is their exclusive supplier of bottles and cans and the syrup to make the drinks. So the bottler buys the syrup of Coca-Cola. In addition to selling the syrup, for every bottle or can that that bottler sells in China, Coca-Cola gets a percentage. All right? So they generate extra revenue. Does everybody understand this? Yes or no? Okay. All right. Let's go on. Okay. All right. Let's talk about recurring and IP models. These are revenues on recurring subscriptions. For example, recurring revenue for continued access to software. For example, if you buy Microsoft Online, Microsoft 365, and every month you pay Microsoft $20, that's recurring subscription fee to Microsoft 365, okay? If you create a brand and actually then provide it as a franchise, you charge franchise fees, licensing fees, that is revenue. Do you understand that? And that comes under licensing and royalties, revenue. Okay, let's go on, guys. Just hold on. What has happened here? Okay, let me share my screen again. Okay, guys. So can everybody see my screen? Can you see my screen, Marvin? Okay. So let's talk about why diversify revenue. Why should revenue be diversified? Because you don't want to put all your eggs in one basket. For example, you can't only sell one type of product, because if that product goes out of fashion, you have no revenue. You have to diversify your revenue. You have to have more than one product available for sale, so you have more than one product generating revenue. Do you all understand this, guys? Yes or no? Okay, all right. So risk reduction, by having more than one type of revenue and diversifying your revenue, you mitigate the concentration risk and cyclability by reducing dependence on a single product or market segment, because you have more than one product selling in more than one segment or in more than one country. And this will, by doing that, you'll have a constant cash flow because you're not reliant on just one product. Okay, customer lifetime value. Does everybody know what I mean by customer lifetime value? You all learnt this, please. I want people to stop giving me a quiet look, and I want everybody now to start talking to me. Okay? Can everybody hear me? Yes or no? Good. Can, can everybody hear me? Great, excellent. If you can't hear me, tell me. Don't wait. Could you hear what I said before? Yes or no? Okay, good. Yes? Okay. All right. So, okay. All right. So let's go back to what we call customer lifetime value. Customer lifetime value is the amount of money a customer spends to you over a long period of time. Write this down. Maribel owns a hairdressing salon. Everybody write it down. I want you to do the calculation now. Maribel owns a hairdressing salon. Okay. Medina goes to her salon once every month. Her average spend is $75 per month. Follow? In an average year, Medina visits Maribel's salon 12 times. Okay? So if Medina spends $75 a month times 12 months, the revenue that entered the business is $900. Okay, so revenue earned from that customer is $900 per year lifetime value. Okay, that's revenue per year. Now, if we ask Maribel, who owns the salon, what is the average profit line for a $75 treatment? And we understand, based on industry in a salon, providing the people who work there are employees, not renting the chair, because in salon business, there's two models of business. Does everybody know what they are? In a hairdressing salon business, the hairdressing salon owner employs hairdressers and pays them a basic salary plus commission, or pays them a basic salary only. The other model is the owner of the shop only has one full-time stylist. All the other stylists only work 2 or 3 days a week. When they come in and use her salon, she charges them a minimum of, say, $200 a day for using her chair and her equipment. So at the end of the day, they pay her $200. They can serve as many customers as they like. All right? There's two different models of running a salon business, okay? But the most common one today is where you employ them, you pay them a basic salary, then you give them a commission. Okay, so let's go back to the model. $900 a year is what Medina spent. We know that out of that profit is, say, 25 to 30%. So if we take that times 30%, so the profit for Maribel out of that customer in 1 year was only $270. Now, I'm only giving this to you hypothetically, all right? Hypothetically. So lifetime revenue is $900. Then you need to calculate what is the profit out of that lifetime revenue depending on your business's profit margin. So lifetime value is the amount of money that the customer spends year on year for the lifetime of that customer. Does everybody understand that? Now, can I ask you, is this an asset or a liability? Who can answer my question? Is lifetime value of the customer an asset or liability? Don't answer, Medina. I know you know, Medina. Don't answer. All right. Who can tell me? Is it an asset or a liability? Okay. All right, Nelson. What is it, Nelson? Is it an asset or a liability, Nelson? Are you there, Nelson? Unmute your microphone, Nelson. Is it an asset or a liability?
It's an asset, sir.
Very good. Can you explain why it's an asset, Nelson? What do you mean by asset?
Yeah, because from the revenue, I every month of $900. I mean, for a year or $900. You got to asset 270, which is 30% of that 900. So it's a lifetime asset for the owner.
So when you go to sell the business, this will increase your selling price because of your customer's lifetime value, right?
Sir, absolutely, sir. Yes.
Thank you very much, Nelson. You're on the right track. Thank you, young man. All right. Does everybody understand what I mean by lifetime value? Yes or no? Do you understand that, Maribel? Do you understand that, Marvin? Let's take a different model of business because I'm getting a look here from some of my students, but I don't run a hairdressing salon. I run a marketing business. All right. Listen carefully. Marvin, you run a marketing business. You do marketing for your customers, or you're an advertising agency. And you have a customer that comes to you every year with an advertising budget. For example, $10,000 a year. They've been your customer for 5 years. That's $50,000 over 5 years, right? Okay, Marvin. Now, you know that on that $50,000 over 5 years, a minimum of 40% of that was profit. So in your book, the lifetime value of that customer would be $50,000 in revenue, $20,000 in profit. Do you understand that, Marvin? So when you go to sell that advertising agency, this will add value to the sale price of the advertising agency once you decide to sell it. Okay? Does everybody understand that? Now, what would customer lifetime value do? Of course, it's going to make your investor hungry to invest, because the more lifetime value you have from customers and the more loyal to you are, the higher those numbers are, the more attractive it will be for your investor to invest in your business. Does everybody understand that? Yes or no? Yes or no? Okay, let's go back to the example before I go on. Did everybody receive their last certificate plus the A1 Excel sheet? Yes or no? Listen carefully. Marvin, you got it, right? Okay, so I want all of you to open that A1 Excel sheet tonight. Okay, I want you to change the A1 company name to your company, hypothetically real or unreal. And I want you to save it as a new file in your computer. Then I want you to write for me at the top what sort of business you're running. What are your products, goods, or services? And then I want you to give me numbers based on the understanding of that business in your country. Okay? Now, as you change your revenue, as you change your expenses, the Excel sheet I've given you will do the calculations for you. All right? Once you've done that, I want you to save it for me, send it to me by email, not by WhatsApp, by email, and tell me in your email, Mr. Wally, this is my homework based on a laundry business, based on a restaurant business. And I will look at it and tell you whether you have the basics correct or not. It doesn't have to be a real business. It can be a hypothetical business. Of course, if you have real numbers that you want me to give you feedback on, when you send me an email, tell me, Mr. Wally, this is for a business that I've been running for 1 year or 2 years, all right? And I can tell you about that. Does everybody understand your homework, yes or no? Now, I want you to do this homework whilst you still remember what all these terms mean. All right. Now, I've been very nice to you. I've given you an Excel sheet that does the calculations. You just have to put in the numbers. So when you go to the Excel sheet and it says OPEX, I've taught you what it means. Do you understand that? Yes or no? Marvin? Okay. Does everybody understand what I said? What about you, Eugenia? I love seeing your smile, Eugenia. I need you to smile more often, young lady. Okay, what about you, Daisy? Did you understand what I said, young Daisy? Almaranes? Good, Daisy. What about you, Salvacion? You've been very quiet today, Miss Salvacion. Smile at me, young lady. Joshua, young man, do you understand what I said? Good on you, Joshua. Okay, good. Let's go back to our lesson, guys. Let's go back to our lesson. All right, can everybody see my screen, Maribel? Very good. All right, so can everybody see my screen, Norishida? Very good. Okay, so remember, why diversify? Risk reduction. Risk reduction is critical to any business. All right. Okay, so next one, diversification. Again, diversification is important because you can transform a singular risk into portfolio strength, ensuring stability amidst market volatility. And what does this mean? Is you need to actually be able to make sure that you have products priced at different tiers. You have very expensive products and you have cheaper products. So if people can't afford the expensive price tier, they at least buy the cheaper tier and you continue generating income. The other one is channel expansion. I'm going to go back to Maribel and her beauty salon. Maribel owns one beauty salon in her little hometown. But in her hometown, there is 25 secondary schools. And she's only getting the students from one secondary school because the other secondary schools are 4 or 5 kilometers away. She might decide to expand by putting one small shop next to every 2 secondary schools and offer all the students at that school a discount if they come and visit her every month. This would be one form of channel expansion, okay? Do you understand that, Maribel? Geographic growth, again, is expanding to different locations, more distribution channels in different countries, not in the same country, in a different city or in a different state or in a different country. And bundling add-ons. Now, bundling add-ons is really good, especially for a business like a food business. You could have an add-on where buy 2 main courses and get 1 bottle of Pepsi free. Now, of course, how do you cover the cost of the Pepsi? You increase the cost of the fried rice by $1. So if they buy 2 fried rice, you earn an extra $2 because you've increased the price of the fried rice, but the $2 covers the cost of 1.25 liters of Pepsi. What does a customer feel? I'm buying a bundle. 2 fried rice plus 1 bottle of Pepsi is only $5. But if I go to buy the Pepsi at the supermarket, I pay $1.80 for it anyway. Here I'm getting fried rice plus Pepsi. So it's a bundle. Do you understand what I mean by that, Marvin? So if they bought the fried rice alone, the fried rice is only $3 each. But if they buy 2 fried rice plus the Pepsi, you sell it to them for $7.50. Okay? But if you sell the bottle of Pepsi alone and 1 fried rice, they'll pay $3.50 for the fried rice they'll pay the full price of the Pepsi, which is $2. Do you understand me, Marvin? So you're putting it into a package to make it more attractive as an add-on. All right, guys, let's go on. Okay, here we talk about fixed costs versus variable costs. What are fixed costs? Fixed costs are expenses that remain constant regardless of production volume or salary activity or sales activity, sorry. They are rent or lease payments, admin charges, premiums for insurance, cost of software. And then we go on to other fixed costs, of course. You also need to take into account salary of your admin staff, okay? Your marketing manager, your salespeople. Does everybody understand that? Yes or no? Now, the risk must be paid even with zero revenue. Now, you cannot say to your landlord, I can't pay you, I have no revenue. The landlord will throw you out or declare you bankrupt. So these fixed costs have to be paid, even if you're not making money. You have to have cash reserves in the bank. Your variable costs. Expenses that change in direct proportion to production, outcome, and sales volume. Cost of raw materials, cost of shipping and delivery, cost of payment processing fees if people pay you through an e-commerce website or they use their credit card through your bank payment system, the bank will charge you 3% or whatever it is, plus the cost of production utilities, electricity for your factory or your kitchen. All right, so remember carefully. Your variable cost is the blue solid line. Sorry, your fixed cost is the blue solid line, and your variable cost is measured against your fixed cost. All right, so remember, the high fixed costs create high operating leverage, more risk, but higher profit margins once the break even is surpassed. So the break even here, if you can see the solid line, is 3,000. So any of the costs above 3,000, okay, anything, once you've actually covered your costs of 3,000, everything you earn above that 3,000 is profit. Does everybody understand that? Yes or no? Okay, good. Okay, let's go on. Managing your cost of goods sold. This is very easy. 1% reduction in the cost of your raw materials will significantly impact your bottom line, often more than a comparable increase in sales revenue. For example, original cost of your raw materials is lowered because you reduce the amount of raw material you waste. For example, if you buy 25 kilos of potatoes, you peel the potatoes more carefully. You don't peel half the potato off and reduce its size. You reduce the waste cost, and therefore you reduce the cost of buying more potatoes to serve the same number of customers. So you optimize the cost, and that would lower the cost of goods sold by lowering the cost of the raw material, and that would give you higher gross margins. Okay, so remember, you can do this by having more suppliers and actually negotiating for a lower cost. All right, you can make sure that you design your menus based on using cheaper raw material. You can make sure you have more leaner operations by making sure you reduce the waste cost in your raw materials, and make sure that you use more efficient product processes and labor processes to reduce your cost of goods sold. You can even use what we call the make versus buy analysis. Regularly evaluate internal capabilities against outsourcing options. For example, if you buy potatoes, you can buy the potatoes, wash them, and peel them internally. Because if you ask the supplier to wash and peel the potatoes, he will charge you extra. Okay, managing your operating expenses. All right, zero-based budgeting. Make sure you automate your workflow and reduce labor cost. Make sure you outsource only if you need to and only if you can save cost. For example, if you are a food restaurant, you only have 2 people in the kitchen and you need to sell 10 kilos of potatoes every day, and you don't have the manpower to peel those potatoes, it may be cheaper to outsource the peeling of the potatoes to the supplier, and it's cheaper than you paying a salary for one person to peel potatoes. So you have to weigh up the cost and strategically whether it's cheaper to outsource that activity or do it yourself. Make sure you monitor your key performance indicators and take action if you're not meeting your targets. Do not wait until you go bankrupt. Efficient operating expense management will directly boost your operational margin without needing price increases. But the only way you do that is to monitor your operating expenses and keep them to an absolute minimum. Okay, let's talk about capital expenditure. Again, I'm going to make this very simple for you. Prioritization framework. Evaluate whether you really need to buy the building or the machinery now. If you don't, then don't buy it. Lease it or rent it. The total cost of ownership. Do you have enough money to actually pay for the equipment and still have enough money to pay your fixed expenses every month? Because if you can't pay your fixed expenses like rent and electricity, you can't use the equipment you bought. Remember, ladies and gentlemen, CapEx planning should be something that you only do once you actually have a proven business concept and you can get an investor to help you, or you can get a bank or a leasing company to lease you or finance your capital expenditure. Okay, now, if you do have to buy it and you have no other option, you have to look on using tax deductible allowances that your government allows on capitalization of equipment and property or land for your factory. And you need to basically make sure you understand what it is you can amortize, and what is it? What does amortization means in your balance sheet, which relates to depreciating the cost of that asset over a number of years. But you need to understand the tax laws available for you and tax credits in your country. Now, the number of years you can depreciate an asset in your balance sheet depends on the laws in your country. Different countries have different depreciation laws for equipment and property. So what is break-even analysis? Break-even analysis, ladies and gentlemen, is fixed costs. Okay, break-even point based on fixed costs. So that's the price. Okay, let's talk about it. Break-even point is the precise sales volume where total revenue equals total costs. Not net income is zero, no profit, no loss. So what we're saying is you sell 500 units for $500, but after you sell them, there is no profit because the cost of those units was exactly the same as what you sold it for plus your expenses. So the cost of the machine was $25. Your expenses were $25. You sold the unit for $50. So you reached break-even point. You didn't make a profit. But you should never rely on break-even point. You should always sell the product at cost plus the right amount of profit margin for you to cover all your expenses plus make a profit. So if you don't know what your expenses are going to be, you cannot actually add on the right profit margin. You need a margin of safety. And the only way you can apply that to your selling price is to understand what your expenses are and going through a financial analysis know-how before you open the business. All right, let's go on here. Break-even calculation. Selling price is $50 per unit. The unit variable cost is $30 per unit. Okay, $50 per unit, selling price. Unit variable cost is $30 per unit. The fixed cost is $100K per total. So, step 2, contribution. Price, $50 minus the variable cost of $20, okay, minus the variable cost, sorry, of $30, leaves you with $20 contribution per unit. So, your break-even point is fixed cost of $100,000 means the contribution of $20 per unit, you need to sell 5,000 units to actually break even. Let's talk about this. 250,000, 5,000 units at $50. At this point, net income is zero because the buffer against loss, the difference between the actual or expected sales and the break-even point. Okay, do you understand that, guys? Yes or no? You have to sell it for more than what you expect. $50 minus the unit variable cost, $30, only leaves you with $20. So you break even. So in order for you to actually make money, you actually have to actually sell it at a higher price. Does everybody understand this? Yes or no? Actual units sold minus the 5,000 break even. So in actual fact, for you to make profit, you have to sell 10,000 units because at 5,000 units, you only break even. How do you measure internal performance? How do you measure profitability on a regular basis? Very easy. You have to compare your actual versus the budget, which is in the financial know-how that I've just sent you in the Excel sheet, which you're going to do before you start your business or on a regular basis if you've already started the business. Remember, guys, it's better for you to use activity-based costing to allocate indirect expenses accurately, revealing the true cost of specific channels. Use indirect expenses accurately, do not estimate. Analyze margins by customer segmentation and by different product lines, so you know which product line is more profitable and which customer segmentation, which part of your customers are more profitable, so you know where to put your marketing dollars. So pricing strategies. The moment you make a mistake in pricing, you're eating into your reputation and your profits. Okay, so cost plus pricing adds a standard markup percentage to the total cost of producing the market. Simple to calculate, but ignores customer demand and risks underpricing in high value markets. Value-based pricing sets prices primarily on the perceived value to the customer rather than historical costs. And this means you have to actually research your competitors, research what everybody else is selling the product for, and come up with a correct competitive pricing margin. Penetration versus skimming. So originally, when you open the business, you might want to penetrate the market. So you would lower the cost and lower your profitability margin in order to get the business, then you'll increase it. On the other hand, you might want to go in with a high price, which we call skimming, high initial price to capture early adopters and lower it over time. So that means at the beginning, you might have lesser customers paying a higher price, but is that an effective strategy for a new business? I would suggest you try the penetration, then increase your price. You could start by using a penetration strategy. Our regular price is $120, but for the first 2 months, you can buy it for only $70. Okay, guys, let's go on. So business financial model components are assumptions and drivers. You need to know what your assumptions are, what your cost drivers are. You need to know basically what are your revenue drivers? How much can you sell the product for? Is there a market for this product? How many retention customers can you retain every year? What are the unit costs? How many people do you need to employ to be able to sell it? What are the economies of scale? Can you lower your costs to increase your profit margin? And what assumptions have you made? Have you allowed for inflation? Have you allowed for tax? Have you allowed for exchange rate if you buy your goods from China? Then there's the engine, the logic and the calculations. You need to go through the know-how financial chart, the Excel that I sent you, and go through it so you know where you would stand financially before you invest in this business. And outputs, reports, and decisions, you need to be able to actually compare your actuals on a regular basis, monthly. You could start weekly, monthly, 3-monthly, etc. In order to be able to stay on track. You need to make sure you're meeting your KPIs, because if you're not, you may have to adjust your selling price or go back and visit your OPEX, your operating expenses. All right, so remember, ladies and gentlemen, metrics are not just for reporting. They are triggers that you have to look at on a regular basis so you can take action to stay in business. For example, gross margin drops. Trigger, price of your products. Okay, you need to actually renegotiate with your supplier to lower your cost of goods sold, or shift the sales mix to more products so you can generate more revenue, or products with a higher profit margin on them. Your operating margins. Trigger, investigate OPEX, lower your operating expenses. Net profit margin is low. Optimize capital structure to reduce interest, review tax strategies, check that you've got the maximum tax incentives, etc. Remember, ladies and gentlemen, no business goes into business to become break-even generating. Every business can be break-even maybe for the first 6 months, 12 months at maximum, but you cannot remain break-even all your life. You have to make a profit. Okay, let's look at this. Real world application. This is a manufacturing case, okay? When they started, gross margin was 32%. Cost of goods efficiency was at based on what they estimated, and the operating margin was at 8%. After they did a review based on the triggers that I just taught you, okay, they were able to increase gross margin up to 40%. They were able to lower cost of goods sold by 8%, and they were able to increase operating margin by 12%. So after they did the review, after they looked at all these triggers, they saw an increment in business revenue and profitability. Okay, now for the first one, manufacturing, high production costs were eating into their profitability. Let's look at the second case. Challenge, unpredictable revenue, lumps, and slow cash recovery. People are not paying their bills on time. Strategic action, shifted from perpetual license to tiered subscription model with annual upfront incentives. So what they did here, instead of getting people to pay one fixed amount, they changed it. They had different levels of software subscription where there was a low price, medium price, and high price. And their revenue went up to 1.9 million, 60% growth. Their break-even point went from 18 months down to 12 months. And their return on investment went up to 45% based on the money they were spending on marketing. So if you look at both of these businesses, the factory implemented design to cost engineering, consolidated suppliers, negotiated lower cost of goods, right? And the other one took action. So they both actually used the review mechanisms that I'm teaching you here. Okay, so the key takeaways from today are: master the 3 financial statements, understand the health of your business, track the vital metrics, okay, track the ROIs, take immediate action, and keep on learning. If you don't know, ask, message, ask me, sir, my cost of goods sold keeps on increasing. My supplier will not give me a lower price. What should I do? Where should I look? Okay, so let's stop sharing and let's talk about anybody who has any questions. Okay, guys, today wasn't simple because I cannot make financial analysis simple. There is certain formulas and rules that I cannot simplify. Does everybody understand this? Yes or no? Yes? Okay. So what I want you to learn today is I don't want you to know the formulas. You don't have to know the formulas. You're not accountants. What you simply have to know is what each heading means. What are operating expenses? What are capital expenses? What are fixed expenses? What are other expenses? Not fixed. What are other expenses? What are the expenses that change every month? What are the fixed ones? All right. As long as you know what all of these are, as long as you know what net profit, gross profit is, what cost of goods sold is, and what the implications of each of these are on the business, you can use an automated Excel sheet to do the calculations. And once you get comfortable with that, if you want to learn the actual formulas and learn how to do it on paper, let me know and we'll do another lesson and we'll get you to do calculations on paper and practice. Does everybody understand that? But in today's accounting world, no one uses paper and pen. It's all done through Excel sheets, okay? Does everybody understand this? Yes or no? Show me hands, please, guys. Come on. Come on, please, please. Okay. All right. Next question is, how many of you have enjoyed today's lesson? Show me your hands. Come on. Is that all? Only 3 people? Only 3 people? Come on, guys. I'm getting worried now. Show me the red hearts. How many have enjoyed today's lesson? Very good. Excellent. Okay. Let me start by thanking my co-host, Miss Medina, and my boss here today for having this session and for making this session open to all of you. Miss Medina learned all this some time ago, and she probably could teach it herself, but that's why I'm here. She keeps me busy. All right. So financial management, ladies and gentlemen, is something that everybody has to endure. Whether you need to do it for your business or you need to manage your own household expenses, it's the same thing. You have to monitor them. You have to understand what's creating those expenses and why you need to make that expenditure and what you can do to lower those expenditures. Does anybody here have children? Put your hand up if you have children. How many of you have children? Very good. Okay. So let me give you an example of children. Let me give you an example about children. My daughter is 8 years old. My daughter doesn't eat strawberries from your regular supermarket because she said the strawberries that come from Malaysia, the Philippines, and China are too sweet. I made a mistake 12 months ago. I took her to a Japanese supermarket and she bought expensive Japanese strawberries, $18 for 10 strawberries. Now, my daughter only eats Japanese strawberries. She needs to eat them every morning with her breakfast for cereal. So my household expenses went up. Why? Because the cost of the good I'm buying and putting in the fridge went up because my daughter was introduced to high-priced Japanese strawberries. That's my fault. I took her there. So I'm happy. It's okay. I can afford it. But do you understand what I mean? How you can apply this to household expenditure? Does everybody understand this? Yes or no? Yes or no? Girls, when you go out with your boyfriend, how many of you have a boyfriend? Come on. I know you've all told me you have boyfriends. Come on, don't hide from me. Very good. Liu, you have a boyfriend. Your boyfriend is poor this month. And he says to you, Liu, can you take me out for a dinner? Liu, you better be careful because once you say yes once, he will be asking you to pay for his dinner every week, Liu. That becomes an expense for you. And suddenly your salary will disappear. All right? So another thing, when you manage your relationship with your boyfriend, make sure that you have a clear understanding about who pays for dinner. Do you go Dutch? You each pay for your own? Or does he pay today, you pay tomorrow? Do you all understand what I mean by managing your expenses? Yes or no? Yes or no? Maribel's laughing. Maribel's probably doing this all along. Okay. Marvin, you have a girlfriend, Marvin? You have a wife or a girlfriend, Marvin? Yeah, okay. All right. So even if he has a wife, every time his wife goes out and says, darling, I need a new Louis Vuitton handbag, he has to control her because otherwise his credit card will be maxed. And at the end of the month, the bank will be chasing him, right? So he has to control his wife's expectations. Yes or no? And for those of you who are not married, I warn you, do not make the same mistake I made. Does anybody know what mistake I made when I married my wife? Medina knows. She's heard me tell this story before. I warned her before she got married. I promised my wife French perfume every month. I promised her a ring every anniversary with a different stone. And I promised her a designer handbag every 3 months. I have been married to her now for some 30 years, and I have kept that promise to date. Do you know how expensive that is? Does anybody know how expensive that is? You know, guys, I could have been $150,000 richer by now if I was single. But it was an expense that I promised without knowing what the real cost is. And now I'm committed to it. She wouldn't say anything if I didn't buy it, but I would feel like I failed. Do you understand that, guys? So if you're about to get married, do not make those promises, okay? Especially don't promise a diamond ring every year, okay? The price of diamonds is going up. I tell you from experience. Does anybody have questions about that? No? Come on, guys. All right, Mary Len, you've been very quiet today, Mary Len. Can you smile and show me that you understood the lesson today, Mary Len? Did you understand today's lesson? All right, Miss Medina, do you have anything you want to say to our students here today? Miss Medina, they're all waving to you and blowing red hearts. Is there anything you want to say to them? Open your microphone, Miss Medina.
No, Wally, but say surprise statement, that's all.
All right, everybody wave and say thank you to Miss Medina, please. Let me see you all wave to Miss Medina. Thank you very much, Miss Medina, for having this session today. Guys, from me, thank you for being my students today. Once again, for those of you who don't know me, my name is Wally Rauder. And for those of you who don't know, I am an Australian. I've been living in Singapore for some 30 plus years. Okay, I've been married for that number of years. The reason I came to Singapore is because I fell in love and my wife shanghaied me and kidnapped me and made me come to Singapore. It's not true. I loved her, so I moved to Singapore. Medina's smiling. Okay. Does anybody else want to ask any questions? Oh, come on, guys, don't laugh at me. It's true. I fell in love. I relocated to Singapore. Singapore's a better country. Lower taxes, higher salaries, cleanest country in the world, no drugs, no corruption. I would never live in Australia again. Singapore is home. I'm the luckiest man in the world. I fell in love. I sacrificed my life, and I'm never going to be happier. Yes or no? Do you agree with me? Thank you very much. Thank you, Eugenie. Thank you. Okay, ladies and gentlemen, until I see you at BizTalk 138. BizTalk 138 will go away from finance, and it will be an exciting new topic. It's a topic that I've never done before. You'll hear about it next week. So I've been looking at topics that are important to business today, and we're going to look at different business models. So we're going to compare the costs of setting up a restaurant in one part of the world to setting up a retail store in another part of the world. And I'm going to give you ideas about different business industries and costs of setup, which is something I haven't done before, but I feel that you're all interested. So I'm going to do one lesson on that. All right. Does everybody want to hear that? Yes or no? Okay, guys. So from me in Singapore, thank you everybody for joining me tonight. It's